Thank you for the hype up, Michael. I'm gonna wait till 10:05 to begin just to let some people flow in here. Hey, Deshaun, looks like we got one more. I'm starting at 10:05 just to give the rest of the registers a chance to sign on before I start. And I'm still gonna leave 15 minutes open at the end for questions. I'm just gonna wait one more minute. We had a handful of people register, but things come up all the time. I'm gonna be doing these webinars regularly, focused on different topics. So this one, guys, is essentially going to be a crash course on multifamily. It's going to be more qualitative focus, talking about just all the different components that are built into, this business and how it's run and the ways of thinking that go into, our assumptions that we build and things of that nature. So I'll just give it one more minute and then I'll jump into things. All right, well, we'll go ahead and get started. For those who don't know me, I see one familiar familiar name in here, Michael. But Deshaun and Brene, nice to meet you guys. My name is Christian O'Neill, founder of Apartment Arbitrage and co-founder of a private equity multifamily company called Legacy Park Capital, based out of Charlotte, North Carolina. It's where my business partners is located, but I'm actually based out of Charleston, South Carolina. So those are our two markets of focus. And to date, we have 7 million in assets under management. We started back in December of 2020, and we partner with experienced, seasoned operators in order to, provide us with the assurance that we can hit our numbers and achieve our business plans and essentially be successful in the business, starting out with little to no track record, but plenty of experience in the multifaceted real estate realm. So I graduated from University of South Carolina in 2020, majored in real estate, worked for a real estate developer for about 2 years. I'm still in touch with him today. He's one of my mentors. And I started Legacy Park Capital with a buddy of mine from college in December of 2020. And we have high hopes this year to take down some more multifamily units, despite the uncertain interest rate environment that we're entering into. So without further ado, let me get into it, guys. I'm going to share my screen here. Okay, so today we are going to essentially be going over the basics of multifamily real estate investing. Essentially, like I alluded to, we're going to be talking on the qualitative points. We're not going to get into any spreadsheets or numbers today. There is so much to learn and so much that I can share with you guys, but we're gonna start it off easy with just the topics of focus, the main points here. And then in farther future webinars, I'm going to get into spreadsheet type work. But I want it to flow nicely, and I want to give people a basis of understanding for them to essentially build up a knowledge base in order to understand the numbers, because it's really important to do that. So let's get into it here. So here's the presentation scope. Like I said, guys, I'm going to end at 10:45 and then give you an opportunity to ask questions if you have any. If not, we'll just end at 10:45. But basically, we're going to go over the fundamentals. So we're going to look at what the pro forma looks like, what it even is, what does a cap rate mean, what does that look like? And we're going to look at a couple other pro forma line items known as the gross potential rent, gross scheduled income, effective gross income, and your net operating income, and what those mean as they relate to the pro forma of a real estate deal and real estate investment. And then also how it ties into the bigger picture of the business. Then we're going to look at underwriting basics. We're going to look at rent and expense growth assumptions and just talk high level what they mean, what's typical in the space of multifamily as far as underwriting goes. We're going to look at the two main return drivers of multifamily: cash flows, and then your sale, which is also known as your reversion value. We're going to talk about positive versus negative leverage, loan to value versus loan to cost debt options. We're going to briefly touch on the logic around the time value of money, honing in on opportunity costs, what that means, and what inflation does to our ways of thinking and our assumptions that go into underwriting these types of deals. Then we're going to look at common partnership structures with GPs and LPs, syndication model. And then we're also going to touch on joint ventures, what the differences are there. And then lastly, we're going to touch on risk and return basics. So there are, different risk and return deals across the risk spectrum in this space. And so in any multifamily or commercial real estate asset class, you're going to have different risk adjusted nature type deals. And I'll get into what that means later on. But essentially, there are three components that are built into the returns we're trying to hit. And it's a function of a risk-free rate of return, a risk premium, and then the spread, which arrives at our cap rate. So I'm getting a little bit more high level now, but we'll touch on that in a second here, so it's more understandable. All right, so just touching on the fundamentals. This right here is a sample pro forma without the numbers. Okay, so what essentially a pro forma is it's a breakdown of income and expenses for a property. And in this case, we're talking about multifamily specifically. So you will see some differences in line items between pro formas for multifamily versus office versus retail versus development pro formas, for example, because you have different assumptions and different capital stacks. I'll get into that later as well, built into these types of things. and different operating expenses. So you see here, there's a payroll expense. Usually you have on-site property managers and on-site maintenance men at these multifamily properties if they justify it, if they're big enough in size. Otherwise, you may not have payroll. For instance, we don't have payroll in one of our properties right now. And so our expenses are lower than, property with payroll, with on-site managers and on-site maintenance. So just starting from the top really quickly, you have your gross potential rent of the property. Your gross potential rent is essentially all you're doing is you're taking all the rents on a monthly basis, you're multiplying it by 12 to get an annual basis, and then you're multiplying it by the number of units. Essentially, you're trying to determine what is the income on an annual basis for each tenant, right? So you're looking at the in-place lease amounts, and you're summing all that up, and you're arriving at this gross potential rent number. And then you have these other line items until you get to your effective gross income. And your effective gross income is the money that's actually rolling into the bank every month, right? After you account for certain things. So in addition to rent, you might have other income charges. For instance, a lot of properties charge for washer dryer rentals, right? To have in-unit stackable washer dryers. A lot of properties charge a community fee, for example, maybe a technology fee if they have smart technology. Also pet fees, right? If you have a dog, usually you'll have to pay either a non-refundable or refundable deposit for a pet, plus a recurring monthly fee. If that's the market that you're in and it's justified, you'll see that a lot. So that's what other income is referring to. Besides rent and your rental amount that the tenant pays every month, there are these other fees that you typically see, and they vary from market to market. So none of them are universally applicable, but you do see some commonalities and some things that are applicable in different markets and vice versa. So after you factor in your other income, add that to your rent, you essentially take out vacancy loss. So the units that aren't rented at the property, typically a healthy property has anywhere from 90 to 95% occupancy. And historically, we've been running a national vacancy rate of 7 to 10% on average is the healthy vacancy rate of a property, just based on historicals looking at a national level. And obviously that varies from market to market, but you subtract out your vacancy loss. So your gross potential rent, this is the number. If every unit was rented at the market price and 100% full, this is what the total income would be and the total sum would be. So I'm getting ahead of myself here. And then you actually end up subtracting out this thing called loss to lease. And loss to lease is basically the difference between your in-place lease number and what the market allows. So essentially, if a market is renting for $1,500, say for a 1-bedroom, say you're in a nice area, right? You have walkable distance to amenities, maybe jobs, maybe you're in a core downtown location and you're paying $1,500 a month in rent. Okay, we'll say that property has a unit lease for $1,200. That means that the difference of what you could get and what's actually in place rental lease wise is $300. So you want to sum all that difference up, and that together is a loss to lease number. So it's a difference between what you could get and what you're actually getting. And we want to subtract that out, obviously, because we're looking to arrive at what we are actually not netting, but grossing on an income basis per month. And then everything's summed together because all pro formas are actually done on an annual basis. So although you can break it down and everybody will account for monthly numbers, you sum it all up into an annual basis, and that allows you to arrive at your pro forma yearly operating statement, essentially. So after your lost lease, like I said, you take out vacancy. I touched on that. And then concessions and non-revenue. Concessions refers to discounts that a tenant might get for moving in. So they're incentives for different properties in different markets to attract tenants, right? So it might be something like, hey, sign a 12-month lease now and you get 1 month off. It may be something like, hey, if you move in by X date, we will give you this discount, X amount of money off, for your first month rent, or maybe just a discount on it. So all the money that you don't collect, essentially, for incentivizing tenants to come in and offering them discounts to the previously stated rental amount, you want to subtract that out. And then you want to take out bad debt, which is essentially your losses that you don't collect. right? So you're not going to collect every dollar. You're going to have evictions per se. You're going to have people who don't pay. And there's just essentially going to be a healthy, typical bad debt amount. It's typically 1 to 2% on a good property. And that is standard. So you want to subtract that out, and you want to assume that there's going to be some bad debt on the property to arrive at your purchase price. Because if you assume that, if you back in to what the price you're going to pay and essentially value the property with zero bad debt, right? Essentially, you're inflating the value, right? And you're pinning yourself to hitting a no bad debt scenario in which all your tenants are paying all the time. So it's just unrealistic, and you're essentially pinning yourself against a wall, which you don't want to do. So once you take all that stuff out, you have your GPR. Like I said, you take out your loss to lease number, take out vacancy, concessions, bad debt. If you have any units that are non-revenue, which refers to essentially people working at the property who are given a unit for free as maybe a tangent to their compensation for working there, they get a free unit. You want to subtract out that, non-revenue that you're not generating, that you're not getting at the property as well. So when you take all that out, and one thing I did forget to mention, RUBS refers to a resident utility billing system. So typically for utilities, and this varies drastically from market to market, but usually your tenants pay some sort of utility, and they may pay it back, or it may be a state in which you can't actually charge and a bill back to the tenants for that amount. You may actually be able to just charge a fee up front that you just state and loop into the rental agreement, right? So in addition to rent and maybe other income fees that tenant has to pay, you may say, hey, you are actually responsible for paying water every time, but I'm actually just going to pay it for you and just charge you a flat fee per month. So it's either a flat fee or a bill back system for the utilities. And typically you see that for water and sewage. We go down to operating expenses, and I'm not going to touch too much on every single line item here because that would take too long and I don't want to bore you guys. But essentially, these are the typical expense line items that you're going to see at a property, minus franchise taxes. So you might be in a state in which franchise taxes apply, for instance, Texas. And we have underwritten some deals in Texas, so that's why this is in here. But in the Southeast, at least, usually you're not going to see franchise taxes, at least in South and North Carolina. You're not. Our markets of focus. So these are your typical operating expenses. You have your payroll, which I already mentioned. You have contract services, which relate to, annual or monthly based contracts on the property related to pest control, right? Grounds and maintenance. Maybe you have an HVAC maintenance contract in which they're essentially upkeeping HVAC condensers and handlers or something of the sort. So you want to account for any contract that is likely to occur at that property. And you're going to have the numbers, and you should have an idea, a very good idea of how that property is performing income and expense wise prior to even making an offer on the property. Because you're going to look at its in-place performance and how it's looking. And then you're going to essentially estimate your own pro forma based on how you think you can improve the property, if any. And you're going to arrive at the price you're going to pay by looking at that spread and then quantifying the risk it takes to get there. So I'll get into that in a second. But besides your contract services, you have repairs and maintenance. There are annual costs to upkeep a property, right? Real people are living there. Properties dilapidate over time, right? You have so many different components. And so it is typical and common and a smart thing to do to allocate funds per unit per year for repairs and maintenance. And you may not use them, but you may, and things always come up and you'll have to do some replacements on the property. So it's smart to do so. Turnover relates to the cost to turning the actual unit. So when a tenant's lease comes due, if you lease that out to somebody else, regardless, once they move out, you're going to have to turn it. You're going to have to go in there and clean. You may have to do some patchwork on the drywall. People are unpredictable, right? You don't know the state that they're going to leave your unit in, but you can protect yourself to an extent in the lease agreement and actually have them responsible for any changes that you see physically. So you can take a picture when they move in, take a picture when you move out, when they move out, and actually charge them for any damage as long as it's stated up front in the lease. But there's typically a turnover cost that you're going to want to underwrite and allocate under the expenses for each multifamily property, because it costs a decent amount of money. For example, right now we're underwriting about anywhere from $700 to $1,500 per turn for properties in our markets. And so you have to go in there, you have to clean. In some cases, you'll have to maybe replace a microwave, for example, right? And paint the property and maybe replace some lighting fixtures and maybe even a toilet or two or something like that. So there are always things that come up. So you want to make sure you are budgeting enough money to take care of the property and have it operate at a healthy level. That's super important. So besides turnover, you have your utilities operating expense. So typically, even though you'll bill back or charge the tenants for certain utility items, you will have these common area utilities, right, that you will have to pay for as a property owner to keep the property running. For example, breezeway lighting and city lighting, parking lot lighting, right? And then also obviously your electric and your water expense for the property, if you have any common areas or not, or maybe you aren't billing back for a particular reason in a market, and your utilities will actually be higher. So that's utilities. Administrative expense. This really relates to, and it's case-by-case basis with property managers. So typically, unless you're vertically integrated and you actually have a property management company, typically you will have a property manager managing that property for you, collecting the rent checks every month, managing accounts receivable and accounts payable billing departments, making sure that tenants are paying, communicating with the tenants, like I said, accepting rent checks and going after evictions that are necessary, things of that nature. So there will be different administrative costs that are associated with the property manager running that property, and those costs will flow right to that owner. So you'll want to make sure that you're accounting for those, just as you are with turnover and maintenance costs and costs that maybe the property manager is fronting for you, that you'll have to then reimburse them through the income of the property. So if you're not allocating for it, that's money's going to have to come from somewhere, right? Or else you're going to have units that aren't leased up. It's going to trickle down and it's going to affect your numbers. And you're not going to hit the numbers that you are underwriting, essentially, which affect your returns. So besides admin, you have marketing costs per unit. It costs money to advertise units for rent, right, these days, right? So you guys are, I'm sure, probably familiar with apartments.com. Facebook Marketplace is actually another great place to market rental apartments on. There are these different services and platforms that you can basically subscribe or pay per advertisement on. So you want to account for marketing because it's not free, right, to get your unit rented, especially in a competitive market in which your business plan necessitates you really positioning your property in a great marketing frame for you to drive traffic to that and beat out your competition, especially if you're trying to push rents, right? You want to position that in a good light. You want to make sure you have the money set aside in order to do that as well. So besides marketing, you have an other line item in here just for, maybe it's a cushion cost or something other than what's already stated. That's typically seen. That's just open, basically discretionary line item for you to put anything in there with. Typically I see that, and not always, but sometimes we'll have, some other costs in there that we'll account for. But these are really the typical ones that you'll see when you're looking at multifamily properties. So management fee, like I already talked about, you will have usually a property manager managing the property and running the show, running the operations. You're essentially asset managing the property manager. So the management fee will look one of two ways. They will either take a flat fee off of the gross income of the property every single month, or they will charge a percentage of the gross collected income of the property. And so it will vary from property manager to property manager, but it's either a flat fee basis or more typically it's a percentage of the income that they collect. And that can be anywhere from, I've seen as low as 3% on a huge core type of property. And I've seen as high as 12% on maybe a rougher type of property that, needs some more work and is more troublesome. But typically you can expect that to fall in the range of 6 to 8, 5 to 8 to 9% is typical. And it depends on the unit size of the property. The higher unit count, the less the property manager can charge, because they're essentially, they're using that scalability of the unit size to collect just as much as they otherwise would. So they need to charge more for the lower unit count properties for it to be worth, their time, because They essentially build in profit margins for themselves over and above, the cost to run the property, and they're very slim. So property managers, their lifeline is essentially covering and managing a bunch of properties and having that scale in order for their business to be lucrative for them. Besides that, you have your property taxes. I won't get into that. Maybe a different webinar will jump into how those are calculated, but those vary from municipality to municipality, right? And they're calculated in different ways based on appraised and assessed values of property. So it can get nitty gritty, and I don't want to get into that, but you have these replacement reserves as well, which are essentially usually lender required reserves, typically $200 to $300 per unit per year per property that you have to budget for and set aside. And those are for, common things that come up on the property. Essentially, they're more cushion and more security for you and the lender as it relates to things coming up on the property that you need to spend money on. And essentially, that's really in essence what that means. So I try to encapsulate, the full picture of the pro forma, and from just a business perspective, right? It really isn't too complicated to analyze a multifamily deal. Obviously, all these line items can get pretty nuanced and they can get detailed, and it can be hard to, fully account for a future expense of some sort. But typically, you just try to do the best job that you can, having the financials from a trailing basis of how the property is historically operated. You're trying to best be realistic, right, with what you have, and arrive at, okay, what is the net operating income of the property 1 year after I take it over, right? What could I realistically take this property to, depending on what type of investment play it is? If it's a value add type of play, you're going to go in and you're going to spend money on each unit to push rents up. And what will you do, right? If all things stay the same, your net operating income should go up. It will go up, right? If you raise rents on the property. So essentially, you're just looking at each multifamily building as a business, and you're saying, okay, this business generates a bunch of revenue, right? There are a bunch of things that offset some of this revenue. I want to arrive at what am I grossing revenue wise, right, per month and then per year. And then I want to know what my operating expenses are going to be, which range anywhere from 30 to 50% plus on the properties, depending on unit size, the market, whether you have payroll or not, on-site maintenance or on-site managers. So there are a lot of different scenarios, but typically your operating expenses are 30 to 50 to 55% of the GPR, right? Or of the effective gross income, rather, of the total collected effective gross income. So that varies, like I said, case to case. But you have your income, you subtract your expenses, you arrive at your net operating income. And essentially, these are the most important things to know, right? One of the most important things to know with respect to multifamily investing, this really is the backbone of everything, right? I mean, here's your operating income statement, and you're essentially taking a bunch of these yearly projections, and you're arriving at what price you can pay for the property based on what return you're going to make on your cash, right? So I'll get into that, but really wanted to focus in on this statement and try to, at least on a high level basis, walk through each line item, what they mean. Obviously, I'm just talking, but I'm recording this webinar and can send it to you guys if you'd like to go back and look at it. But each one of these things you can expect to see when you are underwriting a property, or when you're looking at, for example, an investment offering from another operator and you're thinking about investing. You want to make sure that their assumptions are accurate, right? So you want to have an idea of what are the typical assumptions in this market for this type of property, and is this operator being realistic? Can I with confidence expect that they can hit these numbers, right? And are they being realistic? Because a slight change in any of these projections can severely alter your returns, and that'll look different from each deal that you look at, but it really is true. So you can look at an aggressive pro forma, right, that's showing a 20% internal rate of return, or a 25%, for example, annual rate of return that sponsor is projecting. But if you look into their assumptions and you see that they're not in line with that market, right, and they're totally out of whack being aggressive, okay, you want to discount that return off the bat. You want to discount the validity of that operating statement and those returns in and of itself. So your job is to at least have a basic level understanding of these things so that you can make better decisions actively or passively, whatever that looks like for you. If you're looking to get into this space and really get into something on your own with a few partners, run the show, learn hands-on, or if you're looking to more so place an investment passively in one of the types of business models that multifamily properties can justify, which I'll get into. So underwriting basics and rules of thumb. So you have 3 really important assumptions, basically, that you're going to be making. You're going to be making a rent growth assumption, annual rent growth assumption. So year over year, what is the market's rents growing by, right, as a percentage basis? So typically that's 2 to 3% in any market. And in a growing market, in a solid market that is growing year over year, typically on an equilibrium level, it's a 3% traditional rent growth that operators underwrite to. And why is that? It's because inflation is usually targeted at 2%. So if the value of our dollar is losing by 2% every year, real estate investors are smart enough to know that, hey, I'm gonna beat that, and I'm gonna have a spread over the decreased cost of my dollar every single year. So I'm gonna bump rents across the board 3%. And so basically, because of the ability of property owners to, because of the nature of leases themselves in multifamily apartments, they're 12-month leases usually. They're not that rigid in the sense that you can go and alter them every single year to account for changes in the market, right? And changes in your costs. So typically it's a 3% year over year rent growth that you're underwriting and forecasting. And that will vary on the market. And if it's a seller's or buyer's market, if there's, a bunch of jobs moving into a market at one time, right, and not enough supply. So you really have to look at the supply and demand picture to determine if your rental growth assumption is accurate or not, right? Because if your market, for example, is losing people every single day and you're underwriting even 1 to 2% rent growth, that's probably unrealistic, right? You're not going to hit that. You're not going to hit that number just because there's not enough demand. So you have to make sure demand is exceeding supply in order to hit that 3% in the first place. So rent growth assumption, you have your expense growth assumption. And I kind of touched on this, but typically your expenses will grow at 2% per year. So that will vary based on inflation. And obviously we're in unprecedented times as it relates to inflation, and the pressure in the markets and the supply constraints and bottlenecks that we've seen from the different dynamics at play. But typically your expense growth assumption is 2%. So 2% expense growth. So in all the line items I just talked about and touched on the previous slide, you will assume to grow at 2% year over year in a healthy market and for a healthy property. And then you'll assume to grow your rent by 3% year over year in a growing healthy market as well. And that's essentially, like I said, just the traditional equilibrium type of assumption with your rent and expense growth. And then you have your exit cap rate, which is essentially, we go back and you look at this net operating income number. This is your net operating income. This is the money that basically you have before you pay your debt payment. So most multifamily properties, if not all, are actually going to take on debt. So you're not going to go and buy these properties outright. But if you do go buy them all cash, what an important term, very important term in the business is called is a cap rate. And you essentially take your net operating income and you apply this cap rate to this and you divide it by it and you arrive at the price. So essentially what the cap rate is, it's a measure of return, but it's static. It's not fluid, meaning that it measures a point in time. So at this point in time, based on trailing 12 numbers of income and expenses, what is my property performing on a cash flow basis? If you pay all cash, your cap rate will actually equate to what return you're making on an all cash basis. But since every operator and most every real estate investor places debt into their deals, it changes the game a little bit. So you take your cap rate and that's what you would make all cash. But when you actually lever up, which just means, leverage, levered refers to taking leverage on a property and taking a loan out to boost and amplify and magnify your returns, you're actually going to have returns way higher than that cap rate, because that cap rate is on a basis of all cash. If you paid all cash, this is what I would make. And then you can look at your different debt assumptions. But essentially, this is the golden goose right here of commercial real estate, your net operating income. And then obviously in tandem with that, it's your cap rate, because you're taking your net operating income, you're applying a cap rate to it, and you're arriving at the valuation for the property. Another way to think of the cap rate is what rate or multiple are people paying for a certain income stream, right? So before debt, what are people paying for this stream of income over X amount of time? And that will vary from market to market, from property to property, and across different risk spectrums. It looks different as well. So your exit cap rate is essentially, okay, what price are you projecting to sell your property at, right? And so you're going to apply a different cap rate when relative to what you purchased your property at and the cap rate in place. Typically, you're going to increase that cap rate, which decreases the purchase price of the property when you go to sell. And that's just because properties deteriorate over time, right? New properties are built every single day. So it just makes sense. It makes logical sense and conservative sense from a underwriting standpoint to discount that exit cap rate, or essentially increase the exit cap, which discounts the property value or discounts the value at which you're evaluating or valuing that income stream each year as you hold the property. Because you can just by nature accept the fact that your property is going to deteriorate over time. Okay, people may not want to pay the same rate for these streams that I pay for them. And so being a conservative investor, I want to exit and I want to project a purchase price that reflects a higher cap rate than when I purchased it, just to be conservative. And it just makes for not only a better story and better pitch if you're raising money for a deal, but it also is just more conservative, more risk adjusted, right? Because we're all about quantifying. This business is all about quantifying risk or determining, okay, with this amount of risk I'm taking by buying this property at this price, with these bones in place and with this income and expenses in place, what are my returns I'm generating, right, based on the purchase price? And is that in line with the amount of risk I'm taking on? So it's really a game and an art and a science, more of an art than a science of, okay, for this amount of risk that I'm taking on, am I comfortable with these returns? Or do I basically require a higher return because I'm taking on more risk? In that case, you're going to have to reduce the purchase price to forecast a higher return. And so I know I kind of got a little bit ahead of myself, and we are coming up on 7 minutes, so I'm going to have to play some some accelerated pickup here. But cash flows and reversions, the two main return drivers of a multifamily or commercial real estate investment property, are your cash flows after you pay your debt every month. So you have that NOI number, your net operating income, then you pay your debt service. And then after that, you have free cash flow. So that free cash flow is shared amongst the partners of the deal, right? And so your returns are a function of that free cash flow every single month, and then every single year, and then also your profits from your sale. So those are your two main return drivers, at least quantitative return drivers. And then also there are some tax benefits that are pretty nice if you want to get detailed and look at your after-tax yield or your after-tax returns. There are more benefits to investing in commercial real estate than just your two main return drivers. But those are the two main things that I would like for people to have an understanding of. You have returns generated from cash flow of the property on an ongoing basis every single month, or you should at least. And then you have your reversion value, which is just another word for your sale, right? What profit are you going to make after you pay off your loan when it's time to sell the property? And you're going to share that with your partners in the deal. Positive versus negative leverage refers to whether taking on debt and certain amounts of debt as a percentage of the purchase price actually will increase or decrease your returns. So I'm not going to get into the numbers here because don't have the time, and two, don't want to confuse anybody. And I will save that for another webinar. But there is a point, a quantitative number as it relates to each deal that hurts you if you take on a certain amount of debt. And there's basically a point in which you are magnifying or amplifying your returns by taking on debt, right? And by essentially, for example, taking on 70% of the property's purchase price as debt. Because if you were to take that 100% as equity, right, you aren't going to generate nearly as many returns, because you can go and you can get these low debt payments with interest only in some cases. And then typically your cost of capital all in is going to be lower than what you would make all cash. And so there's just different scenarios there. And I'm probably getting in, too much into that. But as far as debt goes, you really have three main things I would like for you guys to wrap your head around. You have a loan to cost type of debt scenario in which that bank or that lender is loaning as a percentage of the all-in costs of the project, which refers to the purchase price plus reserves, for example, that lender will require, plus your rehab funds and your CapEx funds. So that'll be loan to cost. If they're loaning and basing their loan on the total cost of the project, not just the purchase price, that'll be loan to cost. And more typically, you'll see loan to value types of deals. Not recently, but typically throughout history, it's more conservative to go out and get a loan based on just the purchase price. So for instance, it's typical to see anywhere from 60 to 75%, sometimes 80% in a healthy market, a buyer's market in which property values aren't inflated like they kind of are today. You'll see anywhere from 60, 80% of that property being capitalized with debt as opposed to equity. And then you have two types of main financing. One is permanent financing, then one is bridge financing. Permanent financing refers to lenders looking at in-place income of the property and then backing into the amount of money that they can essentially lend to you. Bridge financing is a whole different space, and those types of lenders actually lend to the future performance of the property, right? So they're actually pinning themselves to giving you a loan based on how the property is going to look in the future, not how it looks right now. So typically, bridge financing is more expensive because of that inherent increased risk in how they're arriving at, the basis for their loan and how much loan they're giving you, right? It's more risky to say, hey, I'm going to loan this money to you based on this property, being improved 20% and making 20% more money than it is now, or I'm going to loan you this amount of money based on how it's performing now. It's much more conservative. So there are a bunch of different debt options out there, and there are way more than this. These are just the main concepts that I wanted to touch on with you guys: loan to cost, loan to value, and then the difference between how lenders lend, if they're permanent or if they're a bridge lender. All right, so the time value of money, I won't spend too much time on this. We have 2 minutes. So basically, as you guys might already know, we are living in an inflationary environment, right? Our whole economic infrastructure is based on an inflationary model in which we have to grow our money supply every single year, essentially to support our infrastructure in the way our economy, in the way our world works, right? Because we have been running a trade deficit with China, right? Most of our GDP of our nation comes from personal consumption. And so we actually have to keep growing, because because we are the world reserve currency of the world, at least for now still, and historically we have been. Our economy needs us to keep growing the money supply, which makes each of our dollars worth less, right? So the time value of money is an important thing in real estate, because investors actually look at their decrease in purchasing power each year as it relates to each dollar. And they try to determine, okay, where do I want to put my money based on every single option that I have to earn a return? And I want to actually look at the decrease in value of a future dollar amount based on what inflation is doing to my money and my purchasing power. So it can get a little bit nuanced, and it can be a hard concept to wrap your head around, but it's an important thing to know and to learn and to fully understand, so that you can maximize your returns and take on reasonable amount of risks as it relates to, whatever you're considering. If you're considering a passive investment or jumping into something more actively, you want to look at your opportunity cost, or essentially, okay, what are my other options out there? And when I analyze both risks of all these options out there and what I'm projecting returns to be, what lines up, right? And I want to look at what am I making, what is the present value of all those future profits that I'm projecting when I'm factoring in inflation. And so there's this one metric in real estate that I'm not going to touch on today, but it's called the internal rate of return. And it actually seeks to do just that. It seeks to actually discount those future funds because of inflation. And it allows us to essentially adjust, right, the purchasing power and the actual returns that we're generating from future values and more, immediate cash flows, and the difference in the actual value and purchasing power of those cash flows and of those profits when you go to sell or refinance the property. So that's the goal of investing. It's to maximize your returns while minimizing your risk. And as I kind of just touched on, you want to create a stream of cash flows worth more than your opportunity costs, or worth more than an alternative investment that you can go after. And you want to discount it back to your present time. So that's actually what the internal rate of return, again, an annual return metric, seeks to do. And I'm not going to get into what the IRR is mechanically, because it can get confusing and we're running out of time here. But basically we have 2 more slides. So I might jump into questions in 4 minutes here. I'll just be very, very brief. 2 common partnership structures in multifamily properties and in commercial real estate in general. You either have syndications, in which general partners or operators of the deal partner with limited partners, or people who are essentially limited in liability and limited in involvement, meaning that they are not running the show, they're not managing the property, they're not signing on the debt, or they're not part of the core team. Syndications refers to the model of general partners partnering with limited partners to take down bigger properties and essentially pool a bunch of investment funds together to purchase property that you otherwise wouldn't be able to if you just have yourself, for example, right? So it allows you to buy bigger properties, better properties, more risk-adjusted properties, because the higher you go up in unit count, the less risky it is, because there's more capital ready to attack that property essentially as you climb up in unit count, because then you dip into the institutional space in which corporations and all these different funds and hedge funds and endowment funds and things of the sort will actually pay, premium prices for property. So that's a whole nother thing there. But there are certain risks involved in syndications, obviously. And then you have joint ventures, in which you essentially don't pool a bunch of money together from a bunch of different people, in which some people are active and some are more passive. Joint ventures, you're essentially partnering with a few partners to take down property. So you're sharing in that risk, and it's more capital intensive because you're going to put up all the money yourself, all the down payment equity monies with your couple of partners. And so it's less legal intensive. For example, you don't have to get an SEC attorney and take what it's called an exemption to publicly registering an investment offering. So that's what syndicates seek to do. They actually file an exemption with the SEC that allows them to go and raise money from a bunch of different people. And joint ventures are a little bit different, a lot of it different, different risk perspective, different capital arrangements. And there's a time and return trade-off, right? In joint ventures, you're going to be active. You're going to be taking on a lot more risk. You're likely going to be signing on the note or the debt for that project. And you have to have specialized skill sets, obviously, or partner with somebody who does, right? So you're going to be dealing with the tenants and toilets, dealing with the property managers. You have to have, obviously a certain level of knowledge and skill in order to do so. So risk and return basics. I could talk a lot on this, but I'm not going to get into this for more than 2 minutes because I want you guys to have an opportunity to ask questions at the end here. But essentially, like I alluded to in the beginning, there is a risk spectrum, a risk and return spectrum in commercial real estate. So you have properties, for instance, if you look at this single family, these are 2 single families, but bear with me. Look how dilapidated and distressed this is, right? So the logic of risk and return in real estate and the logic of analyzing something all is predicated on this risk and return logic of, okay, for this amount of risk that I'm taking, I'm going to require this amount of return. And since your purchase price is a function of what return that you're projecting, essentially backing into that purchase price with your return projections, you want to make sure that you aren't being too aggressive with how risky or not risky a property is, because you're basing your returns off that. And so in general, you should demand a higher return per unit of risk that you're taking on, right? So if you're taking on a property like this one, this abandoned house, you're going to demand a higher return to take on that property relative to if you were to take on a project like this single family house. And don't even focus on, okay, what is this, a cash flow play? Are we flipping the homes? That doesn't matter. It's just the logic of, okay, because this is in way better shape and newer and in a better area on a more risk adjusted basis, I am willing to accept lower returns, which means I'm willing to pay a little bit higher of a price because it's less risky in nature. Conversely, with this dilapidated property, I would want to discount the purchase price and I would want higher returns in order to take on the risk of executing whatever business plan is needed for that particular property, right? So you have different risk and returns and you want to quantify that and you want to have a risk adjusted return, which basically just means exactly what I just said. You want to be paid for your risk and you want to be conscious of how much risk you are forecasting to take on and what your return looks like relative to that. And then you have your investment strategies for different projects in commercial real estate and multifamily, right? So different operators and different funds, for example, have different criterias for investing based on what their capital demands. So whatever's funding that fund or funding that individual investment, typically those investors will have a return and risk profile that they're comfortable with, and you'll want to align that with them, right? You want to, how are you going to go and raise money for a property or take on a property if you're the only one that is comfortable with that investment thesis or with the structure and what your kind of whole, game is there, what the play is with that investment. So you can either invest for in-place income, in-place cash flow, or you can invest for future growth. And I don't want to get into it more than that because I will take up all the time today. But you also have hold period implications. So for instance, you may underwrite a 3-year hold period, or you may underwrite a 10-year hold period, right? There are just different things that work for different scenarios, for different operators and different investors. And so without further ado, I will stop sharing my screen right now. And I want to give everybody a chance to ask questions. We can go over a second on time here if there are, a handful of questions here. But you guys can ask them in the chat, or I believe I'm allowing you guys to talk as well if you do have any questions. So I'm going to unmute all of you. Does anybody have any questions? Preferred lenders for small commercial deals you have worked with. Yeah, David, there are so many options. If you want to, I'm going to put my information here in the chat. And if you want to send me either a direct message on social media, if that's easier, through Facebook, through the group, or if you want to email me, I'll be happy to share, my thoughts with you there. There are just so many options out there, and I'd have to have more of an understanding of what project you might be looking at. I just dropped my email in the chat there. Deshaun, I see your messages. I'll get with you after this. You're welcome, David. I'll just give it one more minute here, guys. And if if anybody has, question that they come up with, feel free to ask away in the chat, or if you're not muted. Renee, yes, there's a massive amount of information here. And so I will be doing future webinars, honing in on more specifics as it relates to the bigger picture. But yeah, as I kind of, mentioned up front, this is not an easy business, although when you break it down simplistically, it's much easier to understand, but there are so many different parts and components. And so I'll be happy to send you the recording afterwards for you to take a look at. You're very welcome.
Good morning.
Hey, good morning.
It's Derek. How you doing, sir?
I'm doing very well. How about
Great.
you?
Thanks for having us today. I was a little late, and then I couldn't quite find the link, but you were nice enough to already have it attached. So,
Absolutely.
congratulations.
I'm happy.
Congratulations.
Thank you very much.
on
I'm happy to.
Charlotte.
I appreciate that. Thank you. I'm happy to send you the recording if you'd like it afterwards.
Absolutely, absolutely. My question would be, I have that 16 units in Clemson, as you're aware of, and we went through the 16 home inspections, and they were a lot more extensive than we ever expected, due to the fact of only at the point of the LOI, I only had the opportunity to get into 3 of the units out of the 16. With banking changing now, the one bank I had in my back pocket is now not going to finance the remodeling aspect. How do you suggest, going from a 400,000 capital raise to a 900? It's almost a 40%, the 35% capital raise. Is that even feasible?
Yeah, no, it absolutely is. It's all a matter of what your return picture looks like, right? If you have to take on less leverage, which is actually more advantageous in an environment like today, right? Like I don't want to, given the interest rate environment now and what we're forecasted to see in the future, I would want to take on less than 70% leverage for deals. So we did one at 75% leverage last month, but things already have changed in a month's time, right? And so the Fed is actually meeting today, and I have to look, and maybe I don't think they already met, but we were anticipating another rate hike today. And so increased equity for the project, right? If they're not going to loan for the rehab funds and you have to come out of pocket with equity, it's not necessarily a bad thing from a conservative risk adjusted perspective, but you just have to look at your returns and what that looks like, right? And you have to be comfortable with what you're forecasting.
Understand totally. Yeah, great approach. And this is a base hit, certainly not a home run project, based on appreciation and the university being so close proximity.
Right.
But yet also, okay. And what's a good IRR on something that's a long-term hold versus expecting not a 2-year refi for your investors?
Yeah. So I think a long-term hold is 7 to 10 years, Derek.
Yes.
So if you're asking a 7 to 10 year hold, anywhere from a 10 to a 13% IRR for a 7 to 10 year hold, I will take that all day long.
Oh, wow. Okay, I'm there.
I'll take that all day long. And that's because if you have a 10-year hold, your typical, 15 to 20% IRRs, right, that operators expect and forecast to investors for 3 to 5 year hold periods, right? Your IRR goes down per year of hold time, right? Because each year that you hold onto the property, those funds are actually those profits and those cash flows are discounted to a higher extent. So it's way harder to achieve a 10% IRR over 10 years than it is a 20% IRR in 3 years, if that makes sense. So I would take 10 to 13% all day long for a 7 to 10 year hold period. You have to obviously look at your cash flows because that'll be more of a current yield cash flow play. You have to be comfortable, right? Your investors will have to be comfortable with that in place yield amount, right? Since it's going to be a longer term hold and you're not going to see any reversion return, any sale return for a decade potentially.
No, exactly. And the great thing is we are, well, I'm of the firm belief in this one model that I'm going to convert it to Airbnb, and in Clemson, it's only a 25 night maximum per property. So, but ironically, during the football season, that it is easily a $600 a night with a 2-night minimum windfall. So we're already going to beat the pro forma just in 25 nights, but yet from an appreciation standpoint, all the expenses will go down dramatically because of the lack of maintenance and deferred maintenance on LTR. This will be STR. So the property will be vacant 300 plus 320 nights, 340 nights a year. But yet the cash flow will spike pretty much in the fall and then in graduation. So, and then the management would be lower at that point. So and then, with the Airbnbs and so forth going up almost 22% this year, I planned on it. I did pessimistically only plan on about a 10% increase in the years after. Would you do anything different?
Okay. That's a little bit more nuanced, Derek. So let me get with you after we end here, and I can touch on that. But I wouldn't right off the gun. There's a few things. Yeah. But we are short on time here. It's 11:02. Brene, I saw your question in the chat box. If you could message me afterwards or contact me with via cell or email, I'd be happy to share with you, my spreadsheet. But all right, guys, we are over on time here. I know that was a lot of information packed in a very short amount of time. Like I said, I'm happy to send the recording to anybody. And please be on the lookout for future webinars that I do. And I'm open to any and all suggestions as well. If you wanted to maybe hone in on a certain aspect of what I touched on today, more so over others, please let me know offline, and be happy to consider doing that in the future. I appreciate that, David. You're helping me just by engaging with me right now. So I'm just trying to reach as many people as I can to help them essentially make better investment decisions with this, apartment arbitrage brand that I'm building out. So if you could drive people to the Facebook group, that would be amazing, David. Aside from that, I'm here to help you guys. Gotcha, Derek. All right. Thank you, guys. I am signing off now.